Free cash flow is a financial metric that is trying to assess how much free cash flow that we get per dollar invested. You can think of it kind of like dividend yield or price over earnings, in which we're trying to assess how much money that we actually get access to per dollar invested. So let me give you an example. Let's say we're trying to calculate the levered free cash flow yield of this business. So we bought 100% of the business and put $500 million of equity to do so. The company generated $50 million in net income, $10 million of D&A, and $20 million of CapEx. Assuming there's no change in net working capital, what is the free cash flow yield? In practice, the hard part is getting the figures into usable numbers like this. But we'll take the $50 million of net income, add 10 of D&A, subtract the CapEx, and get to $40 million of levered free cash flow. We'll then divide this by our equity investment of 500 in order to get 8%. It's also very important to understand if you're dealing with unlevered or levered free cash flow, because if it was unlevered, then we would also try to consider any debt that was on the business and also strip out the interest expense. Free cash flow yield can be a useful complement to IRR because IRR sometimes is pretty back weighted and tends to hockey stick over time.